I am still bullish on gold as an asset. I have been since 2018. There's obviously periods of time where it's better or worse than others. I do like Bitcoin as well as a more volatile but potentially higher returning play of along similar lines. A lot of these natural resource stocks is still very attractive. Same thing for pipelines and same things for value stocks in general. So I think a diverse basket is still kind of a useful way to play it. Historically, with commodity monies, basically you'd have different types of commodity money. So some cultures would use shells, some cultures would use something else. And when technology improves, we figure out how to make more of that type of money. We say, okay, now our fishing boats are way better. We can go out, we can get like a ton of shells and devalue them, right? So we basically humanity's constantly searching for the hardest type of money, the one with the highest stock to flow ratio, meaning that we can't really bring a lot new to market compared to how much is already distributed throughout the market. And over thousands of years, the two that really hold up are silver and gold, especially gold. That's the one that, like, if you look at a century-long chart of the estimated gold inflation rate, meaning that the amount of new gold created every year compared to the estimated amount of above ground gold, it oscillates around 1.5% per year with a very narrow band of 1 to 2%. It's actually like impressive to look at, and that's because it's basically a very high stock to flow ratio asset. As we shifted to more of a fiat-based standard, we shifted away from commodity money and towards fiat money, and that's where after technology, bring in the second part, which is that kind of political power, geopolitical power, kind of shifting roles of power. And after World War II, the U.S. had by far the world's largest navy. We had something like 40% of global GDP. So the United States could go to different countries and just basically make deals with them, kind of like deals you can't refuse, sort of, and say, okay, so we're going to give you protection from other entities and ourselves in exchange for you using dollars, as say you're only going to sell your oil globally in dollars, or you're only going to sell this in dollars, and you're going to hold your a large portion of your reserves in treasuries and dollars. And so due to the fact that we're the large, the Navy that can really kind of defend global supply chains, and due to, just that global reach, we've been able to maintain that system. And essentially what it is, it's the dollar backed by oil, but not really pegged to oil, right? So globally, because, OPEC's been only pricing their oil in dollars, everybody around the world thinks in terms of dollars, needs dollars if they want to import energy. And then on top of that, we layered the euro dollar market, which is basically the debt markets. So, that kind of petrodollar system kind of kick-started the network effect. But then on top of that, all these countries took out debt in dollars. So I think we are getting more digital. And the thing about digital is that it kind of like there's digital versions of all the things we just talked about. So for example, you can have digital fiat, where in some ways fiat's already been digital, but at the back end it's still going through kind of legacy bank pipes with each other, right? So a digital money is something like a stable coin, where basically you deposit fiat at a custodian, they give you a token that is redeemable for that. And unlike a bank deposit, you can then take this token and just trade it among your peers, or custody it. Now, it still has centralization risk because you're still relying on that counterparty, but basically it's more automated, and it's more kind of diversified. There's more kind of payment channels. Now, they can still blacklist that token, so they can say, okay, because that token was associated with money launderers, it's no longer redeemable, right? So there still is that reliance on that central custodian similar to a bank, but it is basically better technology, more automated. So there's that option. Then you can, of course, nationalize that and make like a central bank digital currency version of that. From policymakers' perspective, they like the fact that they can ban cash, they can surveil transactions, they can implement negative nominal yields, they can do sort of things like that. But of course, from the user perspective, we don't particularly want that. And so, all sorts of privacy concerns, control over our transactions. So I think this is a long process, and there can be spikes that happen in the process. Like, so for example, I would describe this entire war, in addition to all the humanitarian concerns, it's kind of an acceleration of some of the stuff I've been talking about for a couple years, and that acceleration was in some ways like I didn't foresee that this would all happen in February, March of 2022, and that this would happen, and that this response would happen. That's all kind of that sort of that new component that accelerates certain things. So you can have, it's like that phrase, like there are weeks where decades happen, and there are decades where weeks happen. So I mean, this was obviously a period of weeks where, like, maybe decades worth of global financial plumbing changes happened in a rather short period of time. They were accelerated. Um, but I think essentially, the dollar, there still is a lot of debt for the dollar, which represents demand for the dollars. It still is, a huge importing country, and so it's not like a light switch goes off, and 6 weeks from now that no one wants the dollar anymore. You'd have to have a pretty significant event for that to happen. Instead, I think we just see you have to watch the percentages over time. What currencies do countries hold their reserves in? What's happening with things like the gold price, and are they changing their practices towards gold or not? So I am still bullish on gold as an asset. I have been since 2018. There's obviously periods of time where it's better or worse than others. I do like Bitcoin as well, as a more volatile but potentially higher returning play along similar lines. I also like, in general, commodity companies, because even though we've seen, like, say, a spike in oil prices, oil stocks are still, kind of priced for lower oil, than it currently is. It kind of assumes that this spike is transitory, it's going to come back down. Whereas I think the longer term kind of pricing for a lot of these natural resource stocks is still very attractive. Same thing for pipelines, and same things for value stocks in general. So I think a diverse basket is still kind of a useful way to play it. There are a couple different components of this. So there's a SWIFT component, and there's the frozen bank reserve, like the frozen sovereign reserve component, which is for sovereign wealth funds, and the large pools of capital that defend their currency. That's actually probably the bigger story for them. And so if we break it into two parts, it's been long known that countries can be cut off the SWIFT system, which adds a lot of friction to their ability to participate in global markets, right? So SWIFT is a lot of people think that's the actual bank connection, but that's actually just the communications system between banks. But basically, if you're cut off from that, it's much harder to transact globally, and that's long been used against rogue states. North Korea, Iran. It's kind of like the quote unquote nuclear option for financial sanctions and things like that. The idea of using it against a country as large, and due to its commodity production is strategically important as Russia, was not something that was most people had on their radar a year ago, including myself. The idea that Russia would be this aggressive, and that the West would turn to this level of response against it. So that's kind of a new attribute of this. Bank for International Settlements estimates that there's $13 trillion worth of U.S. denominated debt in offshore markets. And it could be higher than that. There could be derivatives and other things that bring that number higher. And so all of that represents demand for dollars globally. And so what essentially is a large network effect.